Joyce, just to pick up where we left off, because we were talking about what we're seeing in the currency markets and what we're seeing with the dollar. And so what are the dynamics, just to pick this up and then throw it to our panel here, that are going to matter most this year?
So I would dismiss a lot of the talk about a Davos Accord and even the de-dollarization. I think that's exaggerated. But the weaker dollar, the bearish dollar trade, I think is here to stay. And I think that is because we're at a very pro-cyclical phase in the cycle. When we look at growth trends in the rest of the world, a Fed that is on hold in our view. So I think weaker dollar, but upside risks that we are still seeing on the growth forecasts around the world, not just in the U.S.
Yeah, Michelle, and I know you focus on this quite a bit, this idea of how geoeconomics, geopolitics, and domestic dealings and policies sort of intersect and play out in the markets here. I just want to put up this chart because I think it tells the story, and that is gold versus the dollar over the past, call it, year. It's a very, very dramatic chart. The debasement trade, as we just touched on here. Your thoughts on it?
Morgan, I'm here in Miami at a small business conference, the Biz to Credit conference. And to Joyce's point earlier, there's been a lot of gnashing of teeth over the debasement trade, the weakness in the dollar in New York City and Washington, D.C. But when you get outside of those bubbles, there's an incredible amount of optimism. I'm surprised at just how much optimism I'm seeing here about the U.S. economy. They believe there's going to be a huge increase in demand for credit due to the strength in the economy. And additionally, they're not so worried about the dollar. A lot of people here think that it was abnormally overvalued when it was trading at 110 on the dollar index. And they remember when it traded in the 80s. So 96 doesn't actually look that crazy to them. Additionally, last year was a great year for emerging markets because of the weakness in the dollar and because of lower interest rates here. And they think that's going to continue into 2026, which means a lot of optimism for emerging markets in Latin America, where you can imagine Miami is the huge focus at this point.
I want to get into that a little bit more. But first, Tom Lee, what say you? And how does this play out? Is gold overbought here at $5,500 an ounce?
Gold and silver have been two of the probably most eye-popping trades over the last 12 months, and especially this year. It's hard for me to say how much of that is currency debasement versus investor demand versus price simply driving more demand. As you may or may not know, like some investment funds in China have like the silver ETFs actually trading at huge premiums. So I think it's really eye-popping, but I might just say it might just be a lot of price momentum too.
And we've seen momentum here in precious metals, but not as much in the cryptocurrencies. And so how much of this has been a rotation when you look at some of the recent weakness, Tom, in Bitcoin?
Yeah, crypto's been a huge disappointment because, whether it's debasement or geopolitical uncertainty or central banks easing, those are tailwinds for precious metals. It really should be a tailwind for crypto. But I think crypto had suffered and still hasn't recovered from that October 10th deleveraging. So you've seen the crypto market trying to recover. And in fact, early this year, there was probably some momentum until the whole Greenland surprise, and that caused another round of deleveraging. So I think crypto, in my opinion, is really watching this huge move in precious metals. There's a lot of FOMO for crypto traders, and I think they're actually buying metals. But in the past, these large moves in gold have actually been a precursor to a subsequent move in crypto. So I think part of this is we're seeing a big move in sort of non-U.S. dollar assets, and that follows with crypto.
Joyce, I see you nodding your head.
Yeah, so, we've done some work looking at where gold prices could go, and just half a percentage point increase in the gold allocations by private investors means gold at 6,000. So if you look at private investors having about 3% in gold, if they went to about 4.5%, you could really be looking at, over the next couple of years, gold at 8,000. So part of this is demand for diversification. It's also that you have gold demand coming from many different pockets, private investors, as well as emerging market central banks.
And of course, we see.
And Morgan, there's been a lot of increase in industrial metal demand as well. It's not just gold and silver. We've seen copper, we've seen zinc, we've seen all of these metals move. Part of that could also be because of this huge drive into data centers and the need for electricity. which could be not just a currency play or a dollar debasement play, but it could also be a fundamental play as well.